Hey, welcome to the podcast, everybody. Thanks for joining me here. We've got a few days left in 2011, and hope you have some great plans for Christmas and New Year's. And I hope you have had time to get your shopping done. Talked to a few people today, and they were just getting started, so seems like that's how it is every year. I think today's market kind of summed up 2011, didn't it? The Dow was down 100 points at one day, and as you can see, finished up 4 whole points on the day. And of course, the Nasdaq was the big loser of the day. Nasdaq was down 25 points after Oracle came out yesterday after the bell, and basically disappointed. I think it was their first miss on earnings in a long time. I want to say 10 years. It sounds like a long time. I don't know what it was, but it was a long time. And Oracle had been a pretty strong stock and then disappointed. So that kind of got the futures weak overnight. Now, I usually don't show you the overnight futures, but you know what we did see was we started to see a little bit of strength, and then we had a big pop there early in the 4 o'clock hour. It was all on the fact that the ECB, the European Central Bank, was going to lend all these banks a big amount over the next 3 years, 489 billion euros, which is about 650 billion dollars. And so initially you saw the spike, and then after that spike you saw the markets sell off, and then the futures went negative coming into the open. Stock market opens up, of course, and down we went. We continued until midday, around noon, and then it turned around. We actually got a marginal positive on the day out of the S&P 500. And the reason it went negative was because I think people were saying, wait a second, we thought this was good, right? They're going to save Europe with these loans, well, and help these banks out. But then, again, the markets kind of woke up, investors woke up and said, wait a second, things may be worse than we originally anticipated. Maybe this isn't good news. Maybe this is bad news. Maybe these banks are in desperate need of euros, and that's why the ECB had to do this. So I think down the futures went, and then we saw basically a 2% drop from top to bottom, and then a 1% jump, this afternoon. I think what we saw over the last 24 hours and today is just kind of what this market's been all year, right? It's got this V pattern, or you start off with a 100-point loss and you finish flat on the day, and it's kind of a tale of two markets, and it's been a very confusing year for amateurs and professionals, traders, investors, day traders, you name it. I think it's been a very tough year. But we're looking here. Let's zoom out a little bit from the intraday move and look at the S&P 500 on a bigger time frame. This is the whole year. And in the red, I've got the 200-day moving average, and in the blue, the 50-day moving average. And if you've got two competing forces, you've got the 50, the shorter ones, the 20, the 50 are moving up, looking pretty good, but then you've got the 100 and 200 going down. And so there's a battle brewing here. Who's going to win out? And the internals still suggest that this market will work its way down over the next several months. That doesn't mean we can't trade. That doesn't mean that we can't have a good market for the next, several weeks potentially, or we could have a Santa Claus rally, which would be the next week in between Christmas and New Year's is typically when you would get that. But I want to point something out here because we had a similar situation in November, where we had this little wedge pattern, which was right in here, and that, of course, broke to the downside. Let me redraw it here so you can see it. But basically, we had this, and it broke to the downside. Now what you're going to see is, if we zoom out a little bit bigger here, you can see that we're going to have this wedge pattern that's setting up. And it's going to break, again, one way or the other. Is it going to be to the upside or the downside? We don't know. And that's what we are waiting for, and I think a lot of investors are waiting for, but you're getting a more narrow band that it's going in, and that's, I think, also why you're seeing the VIX do what it's doing, which is to continue to drop. And I've had people ask me lately, is this a good time for covered calls to generate some income? I think it's not, because of the fact that you look at something like a Coca-Cola almost a $70 stock. You could go out and write a covered call for 2 months. It would get you 44 cents or so for a covered call. Is it worth getting a 0.5% and limiting your upside, and you're still not protecting your downside? I don't think so. I would rather go and maybe buy a high dividend paying stock than write covered calls right now. Remember, with the volatility index low, that means call premiums are low as well. So there may be some instances where you could do that, but you're going to have to do it on a really volatile stock, something like a Netflix or something that you may not want to do. So I don't like that right now, but I do think right now you're going to see this pattern develop, and you're going to see a breakdown or breakup. So that's going to happen, I think, pretty quickly, but that volatility is getting tighter and tighter and tighter, meaning the VIX is down. But remember, we've had to hit the 200-day moving average here, here, and here. So we could see it again here and then a rollover. And that, of course, the bulls are hoping that we bust through and saying, look, the longer we take to bust through something, the more likely it is to happen. And that's sometimes true. It's kind of knocking on that proverbial door, and finally you bust it down, and up we go. But again, the internals of this market are getting weaker. They're not better. They're getting weaker. And so if you're going to be in this market, I think, you have to be in kind of what's working, which right now seems to be pharmaceuticals, utilities, basically staples. And on the other hand, you have to be very, very nimble and trade on practically an hourly basis. And that's not what most of you and most of America wants to do. So, but that's the game that we're dealt right now, and you either choose to sit on the sidelines or do one of those other things I mentioned, and that's really the way it's going to be for right now. You know, and I think about 2011, and this is where we look back what happened, just because the calendar seems to turn. Everybody kind of look back what happened of previous 12 months, and predictions come up for the next 12 months. And I'm not going to try to predict because, frankly, I don't know what's going to happen in 2011. I think the market's going to be weaker. At least at some point, we're going to see a tough market. And if it comes in the first half, obviously the likelihood of a better second half is there. But I think to get into predictions is foolish, because what we have to do is invest based on what is happening right now and what we see. For example, if you go back and look at May and June, the stock market was holding up. Economy was okay. It wasn't great, but it was enough to where the stock market was doing fine. We were able to invest in some stuff. But when we had that gridlock in Washington and the debt deal didn't get done in late July, early August, that's when the market changed character, and we saw that tremendous sell-off. As you can see, I mean, the S&P went from 1350 all the way down to 1100, nasty sell-off, and fear really spiked and peaked, and then we had a rally, and of course subsequent sell-off back in September, and it's been volatility ever since. But amazingly, the market is pretty much where it was at the beginning of the year. It's down a little bit, but pretty much where it was at the beginning of the year through all this stuff. When we look at 2011, we have, and I think the things that were there in 2011 are some of the things that are going to be there in 2012. For example, obviously Europe is still a major, major concern. I mean, the fact that they're lending this money and doing some of these things, and everybody seems to be trying to come to the rescue, it's the equivalent of one of your, kind of reminds me of a Christmas theme, Christmas Vacation, when Randy Quaid comes over, right? Can you picture him coming over saying, hey, Clark, I need a few bucks just to get me through the months. Now listen, I got $500,000 of debt, okay, and I can't afford my mortgage, and I just need a couple of months of rent from you, and I need some gas money. Can you help me out? And Clark says, sure, and he whips out his check and he writes him a check, right? And what does that do for Randy Quaid / Europe? What that does is that provides him some cash flow. Temporary cash flow. And that means he can pay his bills for a couple of months. But that doesn't change his debt situation. That doesn't change the fact that he's got all this debt and it's not going away. And I think that's what's going on in Europe. All this debt that's there, you can continue to put patchwork on it, but until there's structural changes, this problem's not going to go away. It's just going to delay the inevitable. And sure, the markets may celebrate it, and they may rally for 2 years. But it doesn't fix the problem. And so what you're seeing is these temporary spikes on these temporary solutions. And with the high-frequency trading that's going on, the problems in Europe, we've got gridlock in Washington, We've got an election cycle coming up, and so there's this political maneuvering to get deals done and not to do certain deals. We had the downgrade of the U.S., and of course all the downgrades of the other countries and the banks being downgraded. Companies are paralyzed, I think, with all the regulation going on right now in this country. So they're hoarding cash. They're not doing anything, laying people off. And what does all that lead to? Leads to investors being paralyzed as well. And I think that's what people are doing right now. There's people that are burying cash in their backyards. There's people that are still stockpiling gold despite its big drop in the last few weeks. People like Glenn Beck are out there terrifying people, telling them to go store food up because they need to get off the grid. And, all this stuff going on does not exude confidence in the stock market. I think what happens is when the volume goes down because those people just simply aren't participating anymore, the high-frequency traders that were supposed to be there to add liquidity and help the market balance out are actually adding volatility. When you get these days where it's down 100 and then it finishes up 250 or, it was down 100 in the morning and poof, all of a sudden it's just gone in the afternoon and up we go, or a day like yesterday where it's up 300 plus points. I don't think the high-frequency traders are adding anything, and I think all these different things that I listed out that were there in 2011, I don't see much changing in 2012. You do have to remember, though, we are in an election year coming up, and everybody is going to be doing everything they can to get confidence up, to get the stock market up. So if you're trying to short the market, sometimes it can be tough. And that's why I've shorted a few times this year, but for the most part I've elected to have a lot more cash. And one of the things I'm going to change about 2012 compared to 2011, assuming things stay the way they are, which they probably won't, nothing seems to stay the same, but I do want to trade a little more. I think there's opportunities out there that I'm missing by not being even more active than I've been this year. I have felt like investors/traders were at such a disadvantage given the ultra intraday volatility that it was simply best to sit a lot on the sidelines and kind of watch the game from the sidelines. And I think that's going to be the case in 2012. There's going to be times where we're going to have to enter that game to play it, but this won't keep up. I think we're at an important threshold where either the market's going to heal up for some reason, and I don't know what that might be, but pessimism's pretty high, or we're going to break down. And as we break down, we're going to have tremendous opportunities there. So I still think, even if the market heals up a little bit, I think you need to keep your stops there. Don't fall in love with things. Realize that things move to a correlation of 1 when there is panic, and we saw that a little bit in August. We saw that pretty much all through the fall. We especially saw it in 2008, right? We saw treasuries go up and everything else go down, and we're even seeing that with gold lately. The correlation of everything moves to 1 except for treasuries during these panic. So if there's some stocks you're hiding out in right now, whether they're tobacco stocks, utilities, pharma, those are places that eventually, if this bear market gets bad enough, those will go down as well. And I own some of those, and I'd have to sell those. It's very comfortable owning those right now with the dividends, and they're going up. But there's going to be a point in time which those will go down as well if the market truly gets nasty. And a lot of people will say, "Hey, U.S. though is in a good spot. We're the best house in a bad neighborhood," and that is probably true. But it's a pretty rough neighborhood, and there's certainly a lot of risks out there, and the volatility hopefully will stabilize a little more. But it certainly hasn't been since August, and it's made it a very tough market, one of the toughest of my career I can remember. Going in one direction, and all of a sudden when you think it's zigging, it's zagging. And you see people like John Paulson down 50%, he's a big hedge fund manager in one of his funds. And you see people like Bill Miller, the guy from Legg Mason, a great mutual fund manager, say, "Hey, the game's changed, man," and he retires. Those are big deals. You see PIMCO shorting treasuries this year and had this horrible call, which looked good at the time, but I'm just saying it turned out to be. You see people like Meredith Whitney, who was very accurate in 2008, saying the muni market would explode in 2011, and it didn't. So, when you see those types of people that are very good at what they do traditionally get slaughtered this year or have very tough years, it makes you say, wow, what am I doing? And what's the strategies that we're trying to do, and how successful are those? So, but I think there are opportunities. There are certain stocks that move on their own accord, and I certainly want to be a little more active in those individual things. For those strategies that involve more trading, do more trading. And I think, unfortunately, having a nickel and dime this market right now is the way to go until we get a resolution one way or the other. We talked about the VIX earlier and how the volatility is low, and so because of that, writing covered calls and things like that, it doesn't seem to be worth it at the time. But this time frame right now, and you can see over here on the right, this time frame, the volatility is very, very low. And to me, that would be okay if we're in a bull market. If you think we're in a bear market, I think that shows complacency. You can see where we are right here. That shows complacency. Anything below this green line. If you take a look back, and again, you have to define what type of market you're in first. And if you think we're in a bull market, then you would ignore that, and you would use these spikes in fear as a buying point. And this is kind of the Eggers fear and greed calculation. But basically, it shows when there's a tremendous amount of fear, it's maybe a good time to buy, and a tremendous amount of greed, and I would say complacency is sometimes a time to sell. And that's not always the case if you're in a bull market, but I think if you're in a bear market, it certainly is. And I would point back to, right in here, early 2008. Remember, we had this sell-off, and then we had this spike up, right? And that was that. During that time, everybody said, okay, the worst is over, and the complacency picked up. Now let me fast forward here. Sell-off, little rally, right? We had this spike in fear back here. We had the spike in fear here. And then you have this ultra complacency. So am I saying we're going to get this big drop? Well, potentially. All I'm telling you is to be prepared for it. Whether it happens or not, I don't know. I just look back at this and kind of looks like one of my my papers in school with red marks all over it. But, I look back at this because, again, these are very important. Right now, I think the people on the street, Wall Street, are saying, look, the volatility index is so low that the market is supported, and it should go up. And I think a lot of people were saying that back in 2008 as well. And, again, all we can do is look back at history and see what's going on. And right now, with the underlying internals weak, the economy still weak, and if we're not in a recession, hanging on by a thread, and there's so much complacency, I think there's room to the downside here. So am I shorting this market? No. In fact, I think we're more oversold than overbought right now. But I certainly am not fully invested in acting like this is 2009/10, where we're buying emerging markets and commodities and everything's just fine. I mean, those places are getting killed this year, and there's tremendous amount of volatility. So if you're going to be in right now, again, income-based things, staples, things that are pay high dividends, high quality, or you do some shorter-term trading and you keep tight stops. But be prepared, because that complacency we saw back in 2008 led to a horrible sell-off where the S&P eventually went from 1,400 at that point down to 666. I know, scary, but that's what the number was. And I don't think this will be like 2008, but I do think we could see lower prices, and I think we should be prepared for it. So my New Year's resolution is to be a little more active and a little more engaging in the market, and not just say, well, let's just wait for the market to settle down. This market may continue this type of gyration, and that may be all it gives you is short-term trades. And for those of you who are retired and want more conservative stuff, you may have to just continue to do what you're doing. But those that are a little more adventurous with at least a part of your money, I think there's some trades to be had, and did some of those this year, but would certainly like to do more next year if the market remains the same. All right, guys, have a great day. Thank you for listening to me this year. Not that this is the last podcast of the year, but in case you're traveling or wherever you don't get to catch this, thank you for listening. Thank you for supporting the site. Those who donated to the site, appreciate it. Google Plus, it's plus Carl Eggers, carleggers.com, twitter.com/Carl Eggers, eggerscapital.com, all those places to follow me. Thank you very much, and we will talk to you soon.